I thought I'd just start off, if that's okay, Marvin. Before I share the screen, I just thought I'd start with a hello, an introduction to everybody. So my name's Mel. I work for an organisation called Big Society Capital. I don't usually go into lots of detail about us, so rest assured, the thing that's probably important to know is that we are a wholesale social investor. Our money comes from dormant bank account money. And we play two roles really as an investor. So wholesaler, we onward lend to organisations like Charity Bank, Unity Trust, Social Investment Scotland, to name but a few. But we also play a role as a market champion. So essentially trying to remove barriers and trying to help increase and improve understanding for social enterprises, charities, voluntary and community sector groups who, as part of just their future plans for resilience and sustainability, need to know more about whether repayable finance is something that can help them. So I do a number of things for Big Society Capital, including looking after all of our work with social enterprises and charities. But also I'm responsible for a project called goodfinance.org.uk, which is where we essentially try to keep all of those educational resources and learning, but also a list of all the social investors across the UK. But today we're going to be talking about social investment tax relief and particularly Get SITR. Before I share the slides, perhaps if I just get Neil to introduce himself and then I'll share the slides.
Okay. Thanks, Mel. Can everybody hear me? Press the right button. Okay, thanks. Yeah, morning. My name's Neil Pearson. I'm a tax lawyer by trade with law firm Mills and Reeve. I specialise around the tax reliefs on investing into businesses and using shares to incentivise people. So that obviously includes EIS and SEIS as well as SITR and the Venture Capital Trust Scheme. And I do a bunch of work around using shares to incentivise employees, mutual ownership structures and employee ownership trusts, that kind of stuff. And I've been involved with the development of SITR. I was one of the authors of the report that led to its introduction, been on the Treasury Working Group on the legislation and so on. So I've been closely involved ever since, helping Big Society Capital in promoting the use of the scheme and publishing guides and that kind of stuff. So that's me.
Right, so just bear with me just 1 second. Getting good. Okay. Right, so what we are going to aim to do today is to tell you a little bit about what is Get SITR. So Neil's told you about the tax relief. He was one of the, as he says, authors of the tax relief, and I joined Big Society Capital just at the point actually that social investment tax relief had just been created. Big Society Capital, along with others, lobbied for the creation of this tax relief because there was and is an equivalent for mainstream organisations, which again many of you will be familiar with. So EIS and SEIS, so Enterprise Investment Scheme and Seed Enterprise Investment Scheme, and effectively SITR is our equivalent. So the tax relief has been created, but actually always the challenge is how do you get people to know about it and work out how to use it. So Get SITR is our campaign, and it's essentially designed to do a couple of things. So education and engagement, so just to let more people know what it is and how it works. And then the second aim is to remove any barriers. One of the things that we found quite early on is the tax relief is quite complicated. I like Neil makes it in my language, says it's quite fiddly. And so we often have had questions or issues potentially that people have said, well, it would be really good if that was clearer, or we had a guide, or we had more information around that. And that essentially is what Get SITR has been created to do. So we now have a dedicated microsite, which is getsitr.org.uk, which has a whole range of free resources for social enterprises and charities. It also has resources for investors and advisors. It contains news and blogs. I know I would love to be taking this webinar today to say that all the work we did to try and lobby and get something into the budget around SITR announcement hasn't worked, but probably not surprisingly against the background of probably much pressing issues. But we have news and blogs, and we did a lot of work for the government consultation at SITR around there. We have information around actually how you might raise investment. So very conscious that we're focusing today on community shares, but essentially we tend to divide investment into 3 types. So taking on community shares or equity, taking on debt, and then the ways that you might raise that money. So either through a community share raise, or through using a crowdfunding platform to help you to do that, through taking on what look like funds through a fund-like structure using SITR, or through doing a DIY raise where essentially you go it alone. We're not going to be covering lots of detail about social impact bonds today, but just to bear in mind that SITR can and has been used with social impact bonds. The other thing that we like to do is share lots of case studies and stories. So we have a range of videos as well as PDFs that are downloadable, and we continue to look for those. We have got quite a lot of backstory or history on webinars. You'll be able to hear Dave Boyle's dulcet tones, as well as Neil and I on a few of those earlier iterations. They're always available. We did some, for instance, around advanced assurance and how to get that. And then we also have a range of podcasts where we've recorded entrepreneurs who have actually raised investment and allowed them to answer their questions. So that's what Get SITR is. The other thing that we're always really keen to do is we actually have an open source database around all of the SITR deals. That's really been helpful as being one of the major sources of information, because when the government put their statistics out, they are usually so far out of date, or at least 18 months out of date. So if you do come across any SITR raises, if you're working on them or you know of them, please do check out the open source database, which I'll make sure that you have a link to, because that's the main basis for any information that we're able to provide to Treasury when we're lobbying them. So before I hand over to Neil, I will just cover some of the things that we were doing just before the budget and around the consultation. Having seen the vast number of responses that were sent to Treasury around the SITR consultation, there are 3 main areas that we've been talking to Treasury and trying to lobby for changes around the simplification and extension of the tax relief. Many of you will know that it's currently on a sunset clause and is at the moment in its current form only around until March 2021. We're as hopeful as we can be that there will be some change to extend it or to continue it after that date. And the areas that we've been particularly talking to Treasury around are the inclusion of community energy, the re-inclusion of asset leasing and leasing assets on hire, which, because we know that causes community groups in particular a real challenge to use SITR, and potentially some step into health and social care around nursing homes. We'll can take more questions around that later if it's useful. But for now, I'm going to hand over to Neil. He's going to do the lion's share of this, and I'll come in on the chat when I can hopefully add something.
Okay, thanks, Mel. Sorry, Mel's in charge of the slides. Thank you. I'm a lawyer, so I can't resist a bit of legal stuff to kick off, which is the legal small print, which basically says, if I say something that isn't true, you can't sue me and you can't sue Big Society Capital. All tax laws in this country, unfortunately, are complicated and fiddly, and the devil lies in the details. So obviously what we're going to do is run through the rules in outline, but this isn't great advice from that point of view. Okay, thanks, Mel. Right, okay, let's start with a bit of recent history, which needs updating even more in the last week or so. SITR was introduced in 2014, at which point, as everybody knows, we had a coalition government, which looked quite like it was going to get voted back in 2015, and we were, of course, a key member of the European Union. So there's been quite a bit of change since then. We had some material changes to the rules proposed in the 2016 autumn statement and the budget in 2017, and it took until November of that year for those changes to come in, although they did backdate the changes to 6 April 17. So as I say, for Brexit, well, SITR is a form of state aid. So at the moment, some of the rules around SITR have been set because they have to operate within the boundaries of the block exemption on state aid set out by the EU. How that's going to change come January next year, who knows? But at the moment, we do know that obviously it's business as usual and we carry on operating within those rules. So in the slides that will be coming up, the changes that were introduced at the end of 2017 are described as new. That's mainly because a lot of us who were there from the start think of them as new, but they're not quite so now. But some of the new ones were regarded as a tightening up, and those are some of those areas that, as Mel said, we've been lobbying to try and get the government to kind of back down on. Again, as Mel said, the government recently consulted on the various tax reliefs available to support investments into businesses. I suspect after coronavirus they'll be looking at it again, but SITR was included in that. The government's response was due to be published. We were hoping it was going to come out with the budget last week, but absolutely nothing so far. The finance bill, i.e. the actual draft legislation, is being published tomorrow, so who knows, I guess there might be something in there, but I'm not sure. So what I'm going to describe now is an explanation of how SITR works today, but if there are changes in tomorrow's finance bill, then certainly by next year we would hope that it is renewed and widened. That is the hope of everyone, I think, within the industry. Okay, thanks, Mel. Right, so this is what I'm going to run through this morning. Basically, a big picture, what is SITR? Kind of describe it in outline. I've said it's really fiddly, but I'll try and make it as simple as I can. I'll explain the tax reliefs themselves, and obviously all tax reliefs, especially these days, are subject to limits, and explain how those limits work. I can get a bit fiddly. Then we'll look at what kind of enterprises can raise SITR money. I know the focus today is particularly on community shares, but I will look at debt as well, because for any special enterprise, that is a way in which alternative funds can be raised. The limits on the amounts, as I mentioned, is a particularly confusing area sometimes for organisations that have already received some state aid, so we'll have a quick look at that. Then explain the key terms and characteristics of an SITR investment. What are the rules around what you can offer to investors in return for their cash, and what are the constraints that the legislation imposes? We'll have a quick look at who can invest, which individuals can put their money in and claim the tax relief, and what limits there are on that. Then once the money is raised, we'll have a quick look at how and when the money that's raised has to be spent in order to continue to comply with the legislation. And then there'll be a few practical points around the process if you are an organisation actually looking to raise funds, and when and how you can actually claim the tax relief, and then a bit of other stuff at the end that I couldn't think of a title for. So that's what I'm going to talk about now. Thank you, Mel. Right, let's start with a big picture. As I said, tax reliefs are complicated, but this is it in essence. So it's a way in which social enterprises can raise funds by way of investment and offer investors tax relief. Obviously, like all of the tax reliefs in the venture field, it was designed to help fill the so-called funding gap, i.e. social enterprises don't have much assets, often don't have much trading history. A lot of people in the finance industry don't understand social enterprises and how they work. And a lot of banks won't lend. So the idea of the tax relief was to kickstart more monies going into social enterprises, which, as Mel said, companies in the private sector have benefited from EIS relief since 1993, and before that there was a venture scheme that replaced the BES. But this was pretty new for social enterprises who've struggled to raise much needed funds. And it works like this. An individual, that's what I call an investor with a pulse, a real person, invests money into a social enterprise, and in return for their money, they either get shares in the social enterprise or debt. The individual who's put their money in then claims tax relief on the amount that they've invested. The social enterprise takes the cash and it applies the funds in a trading activity. And as Mel well knows from having listened to me a few times on this one, I'm going to repeat that one because this is a tax relief to support trading activity. And then after 3 years or longer, the investment can be sold or repaid, or in the case of community shares, can be bought back if it's CBS. But the key point, as I've said for the second time, this is a tax relief that is designed to support trading activity. This is not a replacement or an addition to gift aid, for instance. This is all around supporting social enterprises that trade. But in essence, that's what SITR is. So I could stop there, but there's a few more slides to go. So Mel, if you wouldn't mind. Oh, Mel's disappeared. Thank you. So let's have a look at what the tax reliefs. Let's look at the position from the point of view of the investor. What are they getting back off the Chancellor in return for investing in community shares, let's say? Well, the key tax relief for investors is the income tax relief. They get 30% income tax relief. So you get to the end of the tax year, you work out how much income tax you owe, and you can knock off from your tax bill 30% of the amount you invested under SITR. And there is a what's called a carryback facility. So if you're to invest in this tax year and decided you wanted to claim the relief quicker, you can actually elect to treat it as if the investment was made in the last tax year, the previous tax year. The next tax relief that some more wealthy investors might be able to claim is capital gains tax deferrable. So if you invest money under SITR and you're also lucky enough to have made capital gains on other investments that you might hold and you owe capital gains tax, you can defer that capital gains tax liability by investing money under SITR. So the tax isn't written off, it's just deferred, and you only have to pay that other tax when you dispose of your SITR investment. And then tax-free capital gains. This quite bluntly, is less relevant in the field of social enterprises, but it's on the statute book, so I'll mention it. If you own shares that you have invested and claimed SITR relief on, and then you sell them and you actually make money on the sale, you make a gain, so you sell them for more than you paid for them, you don't pay any capital gains tax on that disposal. As I say, probably less relevant for SITR. We don't often see gains being made on disposals of community shares. And obviously, there's quite a lot of SITR investments are made by way of debt. And there is no such thing as a capital gain on debt, so it doesn't really apply. So those are the three key tax reliefs. Mel, if you want to crack on. I thought I would just give you a quick worked example to explain the numbers and how they work. So let's imagine we have a community interest company that wants to raise a £100,000 loan to refurbish its premises and expand its operations. So it goes to its supporters, and very conveniently, because the maths works nicely, we have 10 individuals who each offer to invest £10,000. And in this case, they're investing by way of debt. So they're entitled to interest, and our interest, let's say, is 5% per annum. And the debt's repayable in 5 years' time. So each investor lends 10,000 quid. So I mentioned the first thing they can do is they can claim back income tax relief at 30%. So they invest 10,000, they can claim back 3,000 from HMRC by way of a set off on their tax bill at the end of the year. So the net cost to the investor is only £7,000. And exactly the same thing would apply if they were investing in shares rather than debt. Obviously, in this example, the investor receives £500 in interest. So let's say interest is taxed as income. Let's say they're paying income tax at 40%. So the net post-tax interest they receive is 300 quid a year. But at the end of the 5 years, the loan is repaid. So the investor gets back 10,000, not the 7,000. So what our investor has done is effectively invest £7,000 of their money, and after tax, they've got back 11,500, which is quite a significant return. And obviously, our investors supported the growth of the community interest company. And with community shares, exactly the same kind of numbers would work if you were receiving interest or dividends on those shares. Okay, thanks, Mel. So that's how the tax relief works. Before I just leave the tax relief, there's one that I haven't mentioned on the slides, but in today's climate, is an increasing amount of airtime in terms of questions that we get asked is around loss relief, which would apply for community shares, or could apply for community shares. So there are some circumstances. If an investor invests in community shares and they lose their money, they may well be able to claim tax relief on the loss, and they may well be able to offset that against other income tax liabilities or capital gains tax liabilities. The rules are a bit fiddly, but certainly if you're doing a share issue under SITR, the position on loss relief is worth emphasising to investors, because if it is available and they can offset it against income tax, it is again a significant further buffer against the risk of investing in a community share issue. And basically the same rules apply as they would do if you were offering EIS to your investors. Okay, so those are the tax reliefs. Oh, sorry, just had a question from Dave Boyle, so I'll just pause on that one. Sorry, I'm just getting used to this. Is loss relief only eligible to people who have claimed tax relief? It's only that's a good question, actually. It's available to any investor. It's just the amount on which you can claim loss relief, if you've also claimed your 30% income tax relief, is less, because the government says, well, hang on, you invested 10,000, but actually it only cost you 7, so you can only claim loss relief on the 7. Whereas if you invested 10 and you didn't claim the SITR, you then claim loss relief on the 10. So if it's available, it should be available to any investor. Okay, so now then let's have a look at who can raise SITR funding. What entities are eligible? Well, the short answer is you have to be a, quote, social enterprise. I'll come on to exactly what that means, or I'll explain some of these in more detail in a moment. So you've got to be a social enterprise. By its name, social investment tax relief, only available for social enterprises. The next thing you've got to do is you've got to meet the, quote, trading requirements. And this is the third time I'll say it, but this is a tax relief to support trading activity only. And only certain kinds of trading activities are capable of being supported by SITR. So there are some rules around what trade the organisation carries on. Next requirement is if you're raising SITR funding, you can't be too big. And too big is quite simple, actually. That's probably the only bit of the legislation that is, because we measure size of an organisation in two ways. We look at the number of employees and we look at the assets on the balance sheet. I've yet to come across one that had more than £15 million of gross assets on its balance sheet, but I have come across a couple of examples of larger charities that employ lots of people. So there's a limit on the number of full-time equivalent employees, which is 250, and you've got to have less than 15 million gross assets on your balance sheet. But in practice, rarely an issue that we come across. The next requirement is that the organisation must not be in, quotes, financial difficulty. Now, until a few weeks ago, this was a non-issue, because the test of financial difficulty is one that relates to some EU legislation, and the Revenue's view was that if you were capable of finding investors who were willing to invest, you can't be in financial difficulty. So it was all a bit circular, really, because if you got a fundraise successfully completed, by its very nature, it meant you would. Weeks ago, the Revenue did publish some more detailed guidelines around how they were going to apply this, particularly because there had been some changes in EU legislation, which they'd kind of forgotten about. And so they published some guidance that said they will look at it in a bit more detail, but there are some rules in there around companies that have suffered accounting losses. In other words, if they're suffering losses and the losses are more than half of their share premium account, then technically you may be regarded in financial difficulty. So it's one to look at a bit more for organisations that have been trading for a while than we certainly we give it a bit more priority now than we used to. Next thing is you can't be quoted on the stock exchange. Again, pretty much impossible for a social enterprise to actually list on any stock exchange, so I'm not quite sure why that one's in there. You can't be controlled by another company. The social enterprise that raises the SITR funding has to be independent. That means it can't be a subsidiary of another organisation or another company. There are also some activity rules around.
Oh, sorry, Neil, could I ask you a quick question on that controlled by another company issue?
Yep.
So Community Share Scotland has developed a set of hybrid model rules which would link a society with an existing organisation, and it would have in place things such as agreements about sharing board members. I just wondered if that would potentially make them not eligible for SITR.
It would be surprising if it could. Unfortunately, the devil is always in the detail. But if it were simply a question whereby you allow another entity to have a say, so let's say you gave let's say you were being supported by your local authority, so you guaranteed that they could have a board member. As long as that board member was one of more than two, so they couldn't actually exercise any kind of control, then that would be okay. The other way in which you can create control inadvertently is if you enter into some kind of collaboration or partnership or shareholder agreement with others, in which you give them some kind of sweeping power to actually run the affairs of the business.
What we have is community benefit societies with organisations with a community anchor share within a community benefit society, which gives them some powers over changes to the rules and issues like that.
Okay, well, it's impossible to say without looking at them, but the starting point is to ask, with that example of the so-called golden share, whatever, does that give you veto rights to stop stuff happening that you don't like, or does it give you the ability to positively dictate how the company is run? Because vetoes tend to be okay. The power to dictate what the company does can be more problematic.
Okay. Yeah.
So I guess that's the starting point as a rule of thumb. Yeah, because typically golden shares are there to say, well, you can't change your constitution without our consent. You can't change the mission of the enterprise without our consent. It's there to stop them doing big stuff that you really don't like. But it isn't there for you can turn around to them and say, right, next month I want you to spend £10,000 on X, or I want you to look at acquiring another social enterprise. You can't drive them to do things, but you can stop them doing stuff you don't like. On the whole, that tends to be okay. That wouldn't be regarded as control.
Great. Thank you.
Okay, so we can't be controlled by another company above us, so we can't have a parent company. And ditto, there are some rules around group structure. So if you're a social enterprise that has subsidiaries or investments in other organisations, if you have a subsidiary, it must be a, quote, 51% subsidiary. In other words, you've got to own more than 50% of the shares, and you've got to actually be able to exercise more than 50% of votes and so on if you have a subsidiary. Now, what that does mean is the subsidiary must have a share capital, because if it doesn't, you can't come within that definition. So we've seen a number of examples, as you might expect, where organisations have subsidiaries that are companies limited by guarantee. That is a problem. An organisation with a company limited by guarantee as a subsidiary cannot be eligible for SITR. And we've seen that as a problem, certainly for some charities. If you've got a subsidiary and the subsidiary is going to use the SITR money, so the parent company raises it and then hands it on to its subsidiary, then that subsidiary has to do two things. First of all, it has to be at least 90% owned. And secondly, the subsidiary also must be a, quotes, social enterprise. And I'll come on to what that means in a minute. And if you're a pretty big charity and you've got property, and you've got a subsidiary that actually holds and runs the property, or at least the title is held by that subsidiary, then the property holding subsidiary, again, must be at least 90% owned. And then the last key rule is you can't be in a partnership. Now, it's worth just looking at jargon here, because when we talk to lots of social enterprises, they'll say we work in partnership with X, Y, or Z, or charities work in partnership with other charities. Partnership here means a legal partnership. Partnership that will be dictated, certainly in England, by the Partnership Act, or formal legal partnership, where you work, quotes, in partnership with others. In other words, you collaborate with other organisations to achieve aims. It would be very surprising if that was regarded as a partnership in law. So normally it's not an issue. Very occasionally we have come across it. So those are the kind of key areas. I'm going to look at a couple of issues in more detail, but I did see a couple of questions that come in. Just bear with me a moment. I think Dave had just raised a question on financial difficulty. If the definition is linked to a value and share premium account, then societies who don't have share premiums, yeah. Yeah, I think you're probably right, actually. I've never looked at it in the context of CBS community shares, but I guess that may well be right. But I'll just have to look at HMRC guidance, so maybe I'll come back to you on that one afterwards. Okay, thanks, Mel. Let's look at a couple of the kind of key criteria for who can raise SITR funding. We can have the next slide. Okay, so I said you have to be a social enterprise to raise funding under SITR. There are four kinds of organisations that can be social enterprises. When the legislation was introduced, obviously there was a huge concern from the Treasury's point of view that people would abuse this, and organisations that weren't really social enterprises would actually try and claim the tax relief. So the Treasury's response was to say, right, we're actually going to limit it by looking at the legal form of the organisation that's trying to raise the funding. And so we come down to a list of four. Charities. So charities can be a trust or a company, but they can raise SITR, either registered or not. Community interest companies, again, any form, could be a community interest company with shares or not. Community benefit societies, provided that A, they're not registered social landlords, and secondly, they are a, quote, prescribed BENCOM. In other words, they have an asset lock in their rules. And then lastly, although I suspect this won't be relevant for you guys, there is a specific form of entity called an accredited social impact contractor, particularly snappy title that Treasury came up with. In essence, that's a special purpose vehicle that is a normal company, private company with shares that typically is set up to raise debt to finance a particular project that the impact contractor has bid and won in terms of performing as some kind of impact contract. So I'm not really going to look at that in any detail. But those are the types of entities that qualify for SITR. If you're not one of those, you cannot claim it. It's that simple. Treasury has given themselves the flexibility to prescribe other kinds of bodies as, quotes, social enterprises for the purposes of these rules. They have to legislate to do it. They've only done it once, and that was around a particular type of social impact bond for accredited social impact contractors. But apart from that, they haven't brought any new kind of entities in. So at the moment, that is the list that we have. And the reason that these entities were chosen is because, other than social impact contractors, they all have a social mission built into their DNA. They all have some kind of social mission built into their constitution, which can't really be changed. So the revenue don't have to look at whether the enterprise is doing good stuff, because that's already kind of built into the DNA of the organisation. And the second reason those were chosen is because they're all regulated by somebody. Somebody has to check that they actually carry out the social or community benefit that they were set up to achieve. So charities tend to be regulated, BenCom's regulated by the FCA, KIC by the KIC regulator, and if you're an accredited social impact contractor, you have to get accredited by DCMS. So they're all entities which have some other regulator. So the tax inspectors don't have to worry themselves about what the social enterprise is doing. Somebody else has done that for them. So you have to be one of those enterprises. Okay, and then the second area that I was just going to focus on a little bit more is trades, because this is probably the area that we get asked the most about, I think, in all of the queries that we get, certainly at BSc. For the fourth time, this is a tax relief on trading activity, so it is only there to support social enterprises with their trades. And as I've said, there is only certain kinds of trades can be supported. Now, the way in which the Treasury approached this was to say any trade is okay unless it's on the list of so-called excluded activities, what I euphemistically call the naughty list. Now, if you do stuff that's on the naughty list, you've got a problem. And if you do stuff that isn't, you're okay. So you can see on the slides, there is a list there of what are regarded as naughty stuff that you cannot do and you cannot raise SITR to support. Some of them more obvious than others, and I will kind of look at a couple in more detail. But dealing in stuff, dealing in assets, shares, all that kind of stuff, not allowed. Banking, money lending was not originally excluded under SITR and now is. That's caused lots of issues for social enterprises, as you might imagine, that are in the area of poverty relief or in the area of helping those in chronic debt. And anything to do with finance in terms of hire purchase finance, for instance, also not allowed. Property development, not allowed. I'll come on to that in a moment. Leasing or letting assets on hire. We've seen lots of issues around that. This was introduced at the end of 2017, despite objections. But it's a real problem for any kind of community organisation that has an asset like a building and uses any spare space in the building to raise revenue by letting other people use it. It can be quite a big problem. Generating licence fees or royalties. Again, this is a new one that was brought in. This would impact on organisations that develop and then license software, for instance, because most of the revenue from software developers is generated by licence fees, and generating licence fees is now on the naughty list. Nursing homes and residential care homes. Again, this was an area that wasn't originally excluded and now is, mainly because Treasury thought that this was an area that was open to abuse by larger care home companies. There has been a lot of lobbying around trying to ease this restriction for community care centres, what I'd call genuine community care homes, rather than some of the bigger companies that set these things up. But so far, we've seen no indication that the Treasury are going to relax that one. Green energy. Again, this wasn't originally on the list and now is. Generation or export of electricity or any other form of energy. Treasury's view is it was heavily subsidised and it no longer needs a subsidy. So sadly, social enterprises, community energy schemes that involve the generation of electricity, not allowed. I mean, we recently looked at one that involved advising on and helping people save energy and relieving energy poverty in poorer areas. That would work as long as we weren't actually supplying the energy or generating it. There's the stuff around activities in the fishery and aquaculture sector, which I never thought I was going to advise on, but we did actually look at one. Bizarrely, hydroponics can work, if anybody knows much about agriculture. But agriculture generally is a sector that is not, in Treasury's view, appropriate for any kind of relief by way of tax, any kind of tax relief. And then there's some anti-avoidance rules around where two organisations are set up, and in effect one business is split into two. So if you imagine you had a business that did some okay stuff and some stuff on the naughty list, there's an obvious temptation to split them into two and have the okay stuff in one organisation and raise loads of money under tax relief. Well, where you do that and the two organisations are too closely linked by common ownership, then that's a fundamental problem. Now, I've said that you can't do stuff that's on the naughty list. The revenues view is some stuff is okay as long as it is not major. And their rule of thumb for is it major is 20%. So if you had a building and you sublet a little bit of it, and that contributed, let's say, to 5% of your turnover, it's unlikely that you're going to have a problem. But if you're carrying on any activity that's on that list, what it means is, as a start-off, you've got to look at the extent of the non-qualifying activity as opposed to the extent of everything else that you do that might be qualifying. And just to complicate it even further, the way in which the rules work for charities is all a bit different. In some circumstances, it's a bit easier for charities to satisfy this test than others. And the reason there's an exception in there for charities is because charities, by their very nature, do charitable stuff. They don't just trade. KICs, community interest companies, do. They're set up to carry on predominantly trading activities. Charities are set up to do stuff that doesn't raise revenue. So there is a kind of carve out for charities and what they do, whereby you only look at the actual trading activities and then look at whether the stuff that's on the naughty list is more than 20% of the trades that you're looking to support. So it gets a bit fiddly for charities, the 20% test, but that's the basic rule. Anyway, and I think I've just had a question, so bear with me a moment. I'll answer that one as I go along. From Dave, does agriculture include community supported agriculture which isn't getting cap payments? On the whole, yes. It's primary production of certain agricultural products. And there's a big long list in a piece of EU legislation, but it covers loads and loads of stuff. But the focus here is on primary production. So if you're producing it, whether you get some kind of other state benefit or EU benefit isn't really the point. If you're involved in primary production, you've probably got a problem. Okay, thanks Mel. Next slide. Sorry. Shouldn't have had a drink of water. Okay, Dave has asked, could I talk about the trap about undertaking any non-trade activity beyond it? Insignificant, which is something that traps many. The rules are, excuse me, to claim the tax relief, unless you're a charity, of course, you have to be primarily carrying on trading activities. And if you're doing stuff that isn't trading activity at all, you can't claim the relief. And stuff that's regarded as not trading at all would include, let's say, investment activity. If you're lucky enough to have some money on you and you invested it in, I don't know, shares or property or another social enterprise, the revenue will look at that and again say, well, to what extent, what proportion of your total activities does that comprise? It's a bit difficult, I'm afraid, Dave, to give any kind of general guidance because it is very much a case-by-case basis. But if you're a charity and you're carrying on non-trading activities, it's probably not that much of a problem because, as I've said, there are specific rules around the trading requirements that apply only to charities because the legislation assumes that charities will be doing it. Yes, Dave, you wanted to say something?
Yeah, it's more that I've had quite a few societies who've applied for tax relief and they've kind of gone, if you look at our, let's say, leasing activity for our community centre, it's below 20% of the turnover. So we're okay, aren't we? And HMRC have come back and gone, oh, no. Because you're leasing, this is not seen as, whilst that's an excluded activity, it's actually also not a trading activity because it's not trade to lease assets. and therefore, since you are not a holding company or a group of companies or a charity, even though the actual contribution of the naughty activity is only 10% of turnover, because it's more than 1% of turnover, they've said you can't have SITR. That's happened on quite a few of my projects. I've actually advised some to create group structures just to trip out of that particular clause.
Oh, okay. I must confess, I've not come across that one. That's absolutely crazy. I mean,
it is.
in the sense of they wasted time changing the legislation so that leasing property was on the excluded list. Well, if it's not a trade, why would you bother putting it on the excluded list? Baffling. I mean, I understand technically the point. If you're carrying the rules say that the social enterprise has to be incorporated primarily or solely for the purposes of carrying on trading activities. And just to expand on Dave's point, there are some activities that organisations carry on which look like trade, but aren't a quotes trade for tax purposes. So they are a trade to any normal person applying the common sense view, but because they're not taxed as if they were a trade, they're not a trade for SITR purposes. And so, as you say, Dave, if you're not part of a group, because there are slightly different rules that apply, or if you're not a charity, because, as I say, the rules are more relaxed for charities, you've got a problem. So you're absolutely right to highlight it, Dave. Not only do we look at trade, we look at stuff that you do that isn't trade. So my starting point whenever I'm talking to an organisation is I just tell me everything you do. How do you make money? What is it that every single aspect of what you do, and then we can assess whether there's some non-trading stuff. So just to look at the changes that we saw in 2017, I just flagged up those that specifically that changed. As I said, money lending knocked out some microfinance projects. So I'm talking to somebody at the moment that is still going ahead setting up a microfinance project in the hope that it might still qualify. If you're an organisation that brokers lending, so let's say you were arranging some kind of, let's say, a peer-to-peer platform under which individuals could lend to, let's say, those in financial difficulty, that could still work. It's only the actual lending of the money. So if the social enterprise actually takes its own cash on its own balance sheet and lends it to others, that's a fundamental problem. Leasing or letting assets on hire, as Dave's flagged out, if you're leasing, it's not a trade at all. But in any event, the Revenue very kindly added it to the naughty list in the legislation. But it does catch more informal arrangements. Community halls that rent out their space by the hour. Obviously, they don't lease it, but they're licensing it to the bridge club and the Pilates class and whatever. Sports facilities that just let you use the pitch and don't provide anything else. Potentially, that's now letting an asset on hire and therefore caught. So we're seeing lots of issues with community facilities. One thing that we look at in this area, if you think you are caught, is organisations that provide the use of an asset, but as part of a wider service. So, just trying to think of an example. If you were letting space for micro businesses to come in and use, but you were providing a whole bunch of stuff, company secretarial support, computers, telephony service, coffee, whatever, cafe. If you're providing a whole bunch of services, of which use of a bit of space was one of them, you may well be able to persuade the revenue that you're providing a service, not an asset. But it's, again, one of those things that we have to look at on a case-by-case basis. If your business includes leasing or letting assets on hire of any kind. License fees and royalties, as I've said, is a problem for some social enterprises that might generate revenues by developing software. We've seen particular examples of social enterprises that have developed software to help their own business and then realised it would be really useful and they could roll it out to others and they could make some money from it. But licensing software at the moment certainly is a problem. And bizarrely, in the other tax reliefs such as EIS and CDIS, licensing software is okay if you developed it yourself. but there isn't that exemption yet in all of SITR. Operating concessions is an issue. If you look on the Big Society Capital website, there's a case study of 2 organisations that from the outside world seem to be carrying on exactly the same activity, but one qualified and one didn't. In those cases, they were piers, seaside piers that were renovated and owned by social enterprises and reopened to the public, having been restored. But in one of them, the main money spinner in terms of generating revenues was a restaurant, cafe and tea room. And one of them ran the restaurant, cafe and tea room themselves. So they took the risk on the business, but they took the profit. Well, that was trading and it's okay. It's not on the naughty list. The other one actually brought in a concessionaire. So they brought in another company to run the restaurant, cafe, that simply paid them a rent by way of a proportionate turnover. In that second example, it was rent. They were licensing the building to the concessionaire and they weren't actually trading themselves, and that created a fundamental problem. And again, licensing assets for community halls and sports facilities continues to be a problem for us. Nursing homes and residential care homes, as I mentioned, Treasury did suggest at one point they would look at exemptions from this for small scale community care homes, but we've seen nothing. And again, as I said, generation or export of electricity have really closed down community energy schemes, other than those on the periphery that help people understand more about how they might save energy or change their practices. So those are the rules on trade that changed in the last couple of years that I think are giving some headaches to people. Thanks, Mel. The next one. And property development. We get lots of questions around property development. Because we get lots of organisations that raise money to do something with the property that they occupy, and they're always concerned that what they're doing is property development. Well, the definition of property development is quite specific. And it means the development of the land where the social enterprise, A, has an interest in the land, so either leasehold or freehold, but also has the sole or main object of realising a gain. In other words, you buy some property or land, you do it up and you sell it for a profit. That's development. Now, most social enterprises raise funding to either buy premises out of which they'll operate or to refurbish or to alter the facilities that they can offer out of a building. That isn't property development. As long as you're not doing it with a view simply to increase the value of the property and then sell it on, that's not development. So if, for example, we've got one at the moment, a classic example, a building that was being acquired and then they wanted to convert it into a community pub and run a community cafe, restaurant, etc. So they want to buy the building and then they want to refurb the kitchens. They've got to rip them out and install a fit-for-purpose kitchen for retail catering. So raising SITR for that is fine. It's not property development. They have no intention of selling the building. They simply want to buy it and then make it fit for purpose. So that would be okay. But as I've said, there are problems if you then buy the building, realise you only need half of it and you start subletting, because we've heard letting is a problem. And as Dave raised the valid point earlier, acting as a landlord isn't a qualifying trade at all. It's not property development, but it's not a trade. And the same goes for buying property and then holding it as an investment. That is not a trading activity at all. So that cannot qualify for SITR. So there is a more detailed note on the way in which SITR can be used to fund property-related issues. There's a note on that on the Big Society website. Thanks, Mel. Okay, I'm just going to pause there. I wasn't sure if there's any questions that I was being asked to answer, so just bear with me a sec. No, okie doke. Right, limits. Yeah, Treasury gives with one hand and takes with the other. All tax reliefs are subject to limits of some kind. SITR, if you're an individual investor, you're subject to a very generous limit, which is that you can invest up to £1 million per tax year. Yes, Mel, sorry, you wanted to pause.
Hello, can you hear me now? Yes?
Yep.
Right, I just wondered whether it might be just worth, before we crack on with the rest of the slides, is just to do a quick recap and show the video that just cements that bit of knowledge about what SITR is and how it works, and then we'll move through the rest of the slides. Is that okay?
Go for it, yep.
Okay, so bear with me.
Imagine I'm a social enterprise or a charity. Often organisations like me need finance to grow, to trial new products or for new employees. In short, we need dough. So for the sake of argument, let's say that this is a charity's dough. It's looking in good shape, might make a few good rolls with it, but we want to do more. So let's say we know an investor who likes our work, believes in what we do, and is keen to support us and make a return. She's got dough and wants to invest in my charity or social enterprise. So SITR allows her to do this in a way that's good for both of us. So let's say that she agrees to invest this dough in the business at an interest rate that is agreeable to her but affordable to us. As an incentive, the government then agrees to give her back 30% of what she invested at the end of the financial year. So our charity then takes our investors' dough and uses it. After an allotted period of time, we then pay back the investment with the interest agreed previously. So our investor gets her dough back with interest, as well as 30% of the original amount from the government in the form of tax relief.
Okay.
Okay, just with me now, I'll go back to the sharing the slides, and then you'll be able to carry on. Where are we?
I think we were at limits.
Yeah, we're on limits. Where are you? There we go. Okay, back over to you.
Okay. Okie doke. Right, as I said, the tax relief, or the amount on which the tax relief can be claimed, is subject to a bunch of limits. And if you're an individual and you're lucky enough to have £1 million spare a year, then that is the cap that you can invest under SITR. For social enterprises, the limits unfortunately get a bit more fiddly. In essence, there are two limits. There's a higher limit and a lower limit. And the higher limit only applies in certain circumstances. So if the higher limit doesn't apply, then you're caught by the lower. Now, the lower limit is around 290,000 quid in any rolling 3-year period. That's the amount that you can actually raise by way of funding. There's a bit of, I say around, because this is de minimis state aid, and the way in which it's calculated, or the way in which the amount of state aid is calculated, is done by reference to a formula which is linked to the exchange rate with the euro and the highest rate at which capital gains tax is paid in the UK. So it actually floats around, but if you just take 290k, I haven't checked it recently, I don't know what the euro is doing against the pound at the moment, but assume it's kind of that kind of ballpark for the limit. So that applies. Now the higher limit, which was brought in at the end of 2017, is £1.5 million over the lifetime of a social enterprise. But that higher limit is only available for a social enterprise that has been trading for less than 7 years. Now, in both of these cases, organisations that have received some form of state aid may have to take the other state aid into account. So if you're relying, if you could only take advantage of the lower limit of 290,000, you then also have to look at, have you received any other, quotes, de minimis state aid? And if you have received other amounts of de minimis state aid, that will reduce the headroom that you have to raise funding under SITR. So your 290 will be lower. Similarly, with the upper limit, the £1.5 million limit, if you have been trading for less than 7 years and you qualify to raise up to £1.5 million, you do then have to look at any, quotes, risk finance state aid that you previously received. So you look at a slightly different form of state aid, say over our lifetime, have we ever received any of that? And if we had, we have to knock that off the £1.5 million cap. So again, if you have received other forms of risk finance state aid, the 1.5 million cap will be lower. Now, risk finance state aid is defined a bit differently. It's any investment where the investor is a venture capital trust, highly unlikely, I would have suspected. Any investment where the investor claimed tax relief under EIS or CDIS or SITR, or anything else that's designated under EU state aid rules as, quotes, risk finance. The Revenue have tried to put a list of those together, but there is no absolutely definitive list, but that list I've given a link to is a helpful starting point. Now, if you want to take advantage of the higher limit, as I've said, you must have been trading for less than 7 years. And trading in this context means we have to go back to the date of the first, quotes, commercial sale that was made by the entity. So if you're a social enterprise that's been raising revenues for more than 7 years, chances are you're not going to qualify. So a commercial sale here means a sale of a product or a service in the kind of commercial marketplace, not something that's just done to test the market, but something that was done by way of a sale. And there are some slightly more complex rules where you may have subsidiaries, because you have to look at the subsidiary that's been trading for the longest. And if you've acquired the trading activities conducted by another business, you may well inherit their birthday. You may have to look back to when that business started making commercial sales, figure out whether you want to go. Now, there is an exception to the 7-year rule for so-called follow-on investments. In other words, if you're a social enterprise that's been trading for more than 7 years, but within the first 7 years of your trading life, you have received some form of risk finance state aid, it's possible that you may still be eligible, provided the new funding is going to be used for, broadly speaking, similar purposes to the old funding. So those are the rules. There are 290k limit generally, but you may benefit from a higher limit of 1.5 million if you made your first commercial sale within the last 7 years. So thanks, Mel. So I warned you this bit was complicated and gets more complex if the social enterprise that's raising the funding has got subsidiaries or has previously acquired a trade. Because as I've said there, you have to look at the commercial sale made by every subsidiary in the group, and you take the earliest date as the starting point. As I've said, if you acquired another business, you have to take the date on which that business started its sales, its commercial sales. And I also talked about the £1.5 million lifetime cap being reduced by risk finance state aid. Well, if you're a group of companies, then you have to look at any risk finance state aid that's been received by other group members, and not just current group members. Certainly in the private sector, we see this as an issue because you have to look at former subsidiaries as well and figure out whether they historically have received risk finance state aid. You still have to take that into account when working out what is the cap that you can raise. So it's worth bearing in mind this is a two-tier system. The low limit is the default, but you may benefit from the higher limit if you've been trading for less than 7 years. So I've put on the slides a couple of examples, which I'll just run through very briefly to explain how this works in practice if you're looking at a larger social enterprise that might be in a group. So if we take example 1, so we've got a community benefit society that's offering a bakery. It's never had a subsidiary. It's never acquired another trade or business. It's never raised any previous risk finance state aid. And it sold its first loaf of bread to a customer on 5th of January 2006. And it now wants to raise £500,000 by way of a community share issue. And the investors want SITR. Well, the short answer is the £1.5 million cap can't apply because it made its first commercial sale more than 7 years ago. Now, if we change the dates, and I'll put the 5th of January 2013 in this slide, so I should have updated that. Let's imagine that was 2014. So in other words, the first loaf of bread had been sold within the last 7 years. It can benefit from the new £1.5 million cap. So we have to, the date of the first commercial sale of an organisation is absolutely pivotal to understanding whether or not you can raise up to £1.5 million. Thanks, Mel. But let's imagine that we have example 1 of a business that's been trading since 2006. But we find out that on the 1st of April 2013, it had raised £150,000 by way of a share issue, and some of the investors claimed EIS relief. Well, that organisation could still be eligible, even though it started making sales in 2006, because it received risk finance state aid within its first 7 years of trading, and it now wants to raise more funding for a similar purpose, because the business hasn't changed. So that business would come within the exemption from the normal 7-year rule and could take advantage of the £1.5 million cap. But then let's say that the bakery that we're looking to invest in has recently acquired a wholly owned subsidiary, another delicatessen that it decided to buy to expand its operations. And that subsidiary opened its first shop in 1999. Well, we can't qualify for the £1.5 million cap, because although the parent company by itself would have qualified, we now have to take as the date of the first commercial sale 5th of March 99, i.e. when our new subsidiary first started making sales. So simply by bringing that subsidiary within our group, we've created the scenario where we are no longer eligible for the new £1.5 million cap. So the basic rule about this lot, the takeaway is, if you're a group of companies or you've ever acquired the operations of another social enterprise or any other organisation, finding out when you made your first commercial sale can be quite fiddly. And also, when working out how much state aid you might have already received, so to figure out what cap are you actually operating under, again, can be quite complicated if you're in a group or you've historically acquired another business. Thanks, Bill. Okay, that's enough about the limits. Bit fiddly, that one. So I'll talk now briefly about the key investment terms. In other words, what rights can you offer your investors, or what limits are there on the rights you can offer your investors? So with shares, there are some rules around the rights that attach to those shares. In essence, SITR shares can't carry a return which is either partly or wholly fixed, either partly or wholly exceeds a, quote, reasonable commercial rate of return. There is no definition more as to what is a reasonable commercial return. So typically we look at what rates of return might be available in the private sector for similar type investments. The reality is, investing in smaller organisations with little assets to back them up, often with a very limited trading record, that's quite a high risk investment. So what is a commercial rate of return is probably actually going to be quite high. So it's not really an issue that we've come across, or I certainly haven't come across in practice, because it is very rare for social enterprises to be able to offer investors an excessive rate of return on their investment. And secondly, and this is the one we come across more regularly, on a winding up of the organisation, SITR shares cannot rank above any other shares. So if you were an organisation that had more than one class of share, it would have to be absolutely clear that the SITR shares could never rank above another class of share. So that's just a question of making sure that your articles of association are drafted properly. It shouldn't be a fundamental issue. But the logic of it is, to the extent there is logic here, is that the tax relief is offered because investors are taking a risk. So the tax relief is not available for investments that have been in any way de-risked. And giving shareholders some kind of preferential return on the winding up is a way of trying to de-risk it a bit. So the focus of the legislation, both with shares and debt, is that anything that might give investors a slightly preferential position or de-risk the investment in any way is not allowed, because that's what the tax relief is there for, to compensate people for the risk. So if you were a Bencom and looking at doing a fundraise, you could, for instance, do a joint fundraise of shares and debt, or if you just wanted to raise debt finance in a particular scenario, there are some limitations as to what the debt looks like. To start off, it can't be charged or secured on any of the assets of the organisation. Again, we have a restriction that the rate of return can't be greater than a reasonable commercial rate of return. And again, we have a restriction that says on a winding up, the investment really has to rank alongside the lowest class of share, which is a way of forcing the debt investors to take a subordinated position. In other words, to take the highest risk of any investor in the organisation. And you can't, more generally, there's some, whether it's shares or debt, you cannot have arrangements in place for the investment to be redeemed, repurchased within 3 years. So SITR is intended to be patient capital. What it allows is it allows for social enterprises to raise monies that don't have to be repaid for a minimum period of time, and the minimum period is 3 years. So you can't have arrangements in place under which an investor is entitled to get their money back within 3 years. Similarly, you can't have in place arrangements that are intended to provide any kind of protection against what would otherwise be the normal risk of making this investment. That's kind of a catch-all, again, for the revenue to attack any attempt to, quote, de-risk an investment. So in the private sector, for instance, with a share issue, if you were to offer investors anti-dilution rights so that they could never be diluted below a certain percentage of shareholding in the company, for instance, that would be regarded as a partial protection against risk, would not be allowed. So we were not allowed to do anything that might de-risk an investment for investors. And then finally, in terms of restrictions on investment terms, there is now a requirement that the investment can't be part of what the revenue called disqualifying arrangements. Now, this is a test that was really introduced to tackle some artificial type structures that have been brought in that the revenue thought were abusive. And what it basically does is it bites where an organisation raises SITR funding, and then at least more than half of the SITR funding is in effect passed through and on to another entity. Or it targets arrangements where the trade might reasonably actually be carried on by somebody else. This is really targeted at artificial structures. In the world of EIS, some entities were created that in effect were offering mezzanine finance, so the money would go into the EIS company and then immediately out to a trading company which used the cash. So in practice, I really wouldn't expect this to be a big issue, because we don't obviously generally see abusive type structures being used in the field of social enterprise. Okay, thanks, Mel. Okay, so those are the investment terms. Then let's look at who can invest. Who are your investors, and which of your investors can actually claim this tax relief? Well, for start off, as I've said, the investor must be an individual, what I call an investor with a pulse. That's a real live person. Can't be a partnership, can't be a company, can't be a trust. It has to be a person. Although individuals can hold their investments via a nominee, which could be a company, it has to be a bare nominee arrangement. The next restriction on who can invest and claim SITR is the investor must be, quote, independent. This is something that was brought in again in late 2017. But what this means is that if you're raising funds from an investor, that investor cannot have an existing investment in the social enterprise, either by way of shares or debt, unless either shares were the subscriber shares, in other words, the shares that were taken when the company was first, or their existing investment was one in respect of which they claimed tax relief. So if you have an existing investor that doesn't fall into one of those two categories, they cannot now make a further investment and claim SITR. I've yet to hear an explanation as to why this rule exists in the field of social enterprises. I think it's particularly harsh because it punishes loyal supporters who may have offered some kind of support, even if by way of a loan, because it stops them then claiming tax relief on following their investment. But there we go. You can't claim two tax reliefs on the same investment. Sounds pretty obvious, but you can't put money in under SITR and then try and claim EIS or CDIS as well. And there are some slightly convoluted restrictions on being an investor where you also have some kind of role to play in the organisation that you're investing in. Whether you're an employee, partner, trustee, or paid director, there are some restrictions. Particularly, trustees of charities, for instance, can never claim SITR on investments. And there are restrictions on employees and paid directors of organisations being able to invest and claim SITR as well. And these restrictions apply equally to associates of employees and trustees and directors, spouses, children, grandchildren, etc. And then we also have a restriction whereby our investor can't have a material investment or interest in the social enterprise. This is a rule that is basically designed to ensure that the tax relief is available for smaller investors who don't have too big a say in the affairs of the social enterprise. So in essence, you are a big investor if you own more than 30% of the voting power, which is an issue for shares, the ordinary share capital, and that is a test by reference to nominal value of the shares, or the loan capital of the organisation. So very material investors in a social enterprise can find themselves excluded from investing under SITR. And there is an overriding requirement that an investor can't control the social enterprise. So let's say you rigged things so you held 29.99%, but then had some kind of operating management or shareholders or investment agreement that actually gave you the ability to control board decisions. Then, although you don't own the organisation, you can control it, and that would mean that that investor could then claim SITR on an investment. So that's the people. Let's look at what happens once you have raised SITR funding. How can SITR money be used? Well, let's look at, first of all, who uses the money. Well, the answer is either the social enterprise that raised the cash in the first place, or a 90% social subsidiary. In other words, a subsidiary of the parent that is owned at least 90% and is also a social enterprise, i.e. is one of those organisations I listed at the start. So that's who can use the money. How can the money be used? Well, for the fifth time, the monies have to be used in a qualifying trade or in preparing to start a qualifying trade, i.e. a trade that's not on the naughty list. And the SITR monies must be used for the purposes for which they were raised. Sounds pretty obvious, but if you've issued a prospectus saying you're going to raise the money to buy a building, you can't then use the money for something completely different. Generally speaking, the money can't be used in acquiring shares or stock in another entity or enterprise. If you're buying existing shares of another entity, that would be regarded as an investment. and therefore not eligible for SITR. However, Mel and I have worked recently on a clarification with HMRC around a scenario where if you had a subsidiary and you wish to use SITR to apply to subscribe for more shares in the subsidiary, as long as that results in the subsidiary then having the cash that it can then use in its qualified trade, that may well be okay. So the restriction really is on buying existing shares in other entities or organisations. And you can't use SITR money to refinance an existing debt. Because originally when SITR came out, it was regarded as a fantastic way for social enterprises to be able to refinance expensive bank debt with much cheaper tax-relieved SITR debt, with also a 3-year repayment holiday, so which was fantastic. But they closed that down at the end of 2017, so you can't use SITR money to refinance an existing debt. We have seen an example where the revenue did actually allow a bit of an overdraft to be paid off using SITR monies. But if that's something you were looking at, you really ought to go to the revenue to make sure they're happy that it works. And then finally, when must the money be spent? This is rarely a problem for any social enterprise I've ever been engaged with, but social impact contractors have 24 months to spend the SITR money, and all of the social enterprises in effect have 28 months in which the SITR money must be employed. And if it isn't, then the investors have the tax relief clawed back. Okay, thanks, Mel. Process for claiming the tax relief. Well, before the investment is made, as I'm sure you well know, you can go to HMRC and seek an advance assurance. In other words, ask them to tell you that the tax relief will be available when investors make their investment. It's not compulsory, but if there is any doubt about any area of what I've just been running through, any area that you think is a bit grey in terms of whether you're eligible or not, this is a fantastic way of making sure it's okay, and of also giving your investors real comfort that they are going to get the tax relief. The application for advance assurance is by email, but it takes a long time to get a response. At the moment, between 6 and 14 weeks. 6 is very lucky, 14 is a bit unlucky. I had one back in about 10 weeks recently. We have found the revenue very helpful on individual queries, but for an application for advance assurance, they did promise that they were going to cut this to 15 working days. And in fact, now when you apply one, you get a response saying 40 days. And in fact, Dave has just said he's got one back in 4 weeks, which is fantastic. And Toby has asked, when you say submit by email, what is submitted? Is there a form? No, not a form at the moment. There is on Big Society Capital's website a template which we worked up to help you as a kind of a guide. It has in it at least references to everything you might possibly include within the application. One of the issues we've found with some organisations that have done it themselves is they submit. They haven't included everything in the initial application, and so the revenue then write back 6 weeks later and say, please could you send us X? And then they wait another 6 weeks before they start looking at it. In other words, if you don't send them everything immediately, you really are prolonging the timetable. So it's really important to get everything in up front. So there's a bunch of stuff on BSC's website that can help you with that, and template clearance applications that you can then submit with supporting documentation by email. So if you are going to, quite obviously, if you are going to apply for advance assurance, build it into your timetable. And if you're lucky enough, like Dave, to have got one back really quickly, then fantastic. Typically, we see prospectuses for share issues going out in which we simply say, we have made an application to HMRC, but obviously beware against giving a guarantee to investors that you're going to get the clearance that you've asked for. And then post-investment, what do you have to do? Well, the process is kind of twofold and bureaucratic. First of all, the social enterprise itself, not you, not the investors, but the social enterprise itself, has to submit what's called a compliance statement to HMRC, a form SITR1. It's a standard form available on the website. You download, you fill it in, you send it in. It has to be submitted by the social enterprise. And in most cases, there is a time limit of around 2 years after the end of the tax year to submit it. And if you miss that deadline, then there are virtually no excuses that the revenue will accept. There isn't a kind of a reasonable excuse for late filing. And if you haven't submitted the compliance statement, then the investors can't claim for tax relief. That's simple. If you were doing multiple fundraisers, either a share issue or debt that was being, and you're having partial closures of the fundraising, then a separate compliance statement is needed for each tranche of the investment. So any shares or debt issued on a particular day, you need one compliance statement for that day. Thank you, Mel. So why bother? Well, obviously, we think and hope there are lots of investors out there looking to achieve a social and a financial return and support social enterprises. So any fundraise that can offer investors a 30% discount by a tax relief is almost inevitably going to put itself at an advantage. And hopefully over time, as SITR takes off and is hopefully widened, as we've been lobbying for, there will come a point where some social investors might start to expect SITR to be available. And if you can't offer it, then maybe there will be a competitive disadvantage in the fundraising market. And if you wanted to raise money under SITR through debt, there are some pretty obvious benefits, because for a start off, you can offer a much lower rate of return to investors because their rate of return is being funded primarily by the Treasury. If you're borrowing money, then SITR debt can't be secured, whereas banks typically will only lend if they can take security. There is a minimum 3-year repayment holiday, which you'll never get with a bank. No kind of covenants, no obligations to repay early, so you get a complete 3-year breathing space. And quite obviously, whether it's shares or debt, lenders in this kind of arena are likely to be more engaged in your social mission than a third-party lender like a bank. And quite obviously as well, as I'm sure you've already experienced, angel investors through share issues will invest a lot more than just money. They'll invest their expertise, their time, their contacts, if you're lucky, and some advice. So, in short, it's a bit of a no-brainer if you can offer it. Thanks, Bill. So where might we see it being offered? Well, charities with trading subsidiaries, charities which carry on primary purpose trading themselves, any other kind of social enterprise that's looking to raise finance that trades. Obviously, 7-year rule is now relevant for those looking to raise larger amounts of money. One area that I think has been less explored is larger organisations that might be setting up joint ventures with others. So we've seen big charities that would not be eligible for SITR by themselves setting up specific new ventures, but partnering with other organisations. So they create a joint venture company, which is not controlled by any one of the individual parent entities. And that might well be able to raise SITR funding. New facilities being established to take over the running of facilities from local government. Social impact bonds I'm not going to really touch on in the context of community share issues. And then, to be fair, the emphasis has been on debt fundraisers. That's our experience in terms of SITR. There's obviously nothing that that stops you from issuing shares subject to the constraints that I've mentioned, and the shares can be redeemable. Obviously, bear in mind the 3-year limit. Okay, thanks, Mel. Maybe leave Mel. I don't know if you want to talk about how you go about finding investors, or shall I? Are you going to cut in on that one afterwards? Okay, I'll leave Mel to come in on that one afterwards. So that's it, really. Just to recap, remember this is a tax relief for social enterprises, whereby individuals invest money in social enterprises in return for which they get shares or debt. Our individual, the investor with a pulse, claims tax relief, 30% income tax, capital gains tax deferral on the amount invested. The social enterprise takes the money and applies it in a trading activity. Remember, this is a tax relief for trading activities. And after 3 years or longer, the investor may be able to recoup their investment if they bought back, sold, repaid. And for the last time, it's a tax relief to support trading activities. That's it. There's loads more detail. Happy to answer any questions you've got. Happy to hang around for as long as you wish. There's loads of stuff on BSC's website. That's me.
Okay, lovely. Thank you, Neil. What I thought I would just do is just do a quick recap on a couple of things, and also I was quite keen to show you some of the things that we have been talking about. So lots of this information, I've taken notes of all the questions that were asked, and there are a few things where we've talked about extra guidance on subsidiaries or the pre-assurance templates. I'll make sure that I include those links for you. But what I thought that I would just do is, just want to find the, here we go. Zoom, and I'll share this with you. Hit the dab hand at this, just about, I think. So here we go. So you should be able to see this is Get SITR. And some of the things that I have talked about here. So here is the 3 different types of information that we provide for charities and social enterprises, for professional advisors like yourselves, and also for investors. Some of the things that we talked about in terms of the types of capital and the features, how it works, and the video that we showed you. But I wanted to just cover a couple of things. So one of the other things that was requested quite a lot is the am I eligible? So lots of the things that Neil has covered today are boiled down into this eligibility checker. It doesn't go over every nuance, but it's quite a good way if you've got an organisation that's seeking to think about whether SITR might be relevant for them, so they can go through here, goes through all of the different things we talked about: size, ownership, subsidiaries, how old they are, etc. I also talked about the open source database, which you can find here. So we are always particularly looking to make sure that we have got all of the information. And if I just show you, so we used this recently actually to be able to talk to government about how many deals there'd actually been. So they're all listed here. So if you know about any that you think might not have been listed, please do go and have a look. And for instance, the reason that we make this available is that we're able to say at the moment we think there are about 85 deals, or about £14 million, and that's at least significantly ahead of where government thinks we are. There's a lot of tabs, isn't there? That's one of the things that I struggle with. Okay. Should be there again. Hopefully you can still see that. Right, okay. So some of the things that we have talked about in terms of the additional guidance. So I will just show you where you can find these. So here on applying for advanced assurance and the help on advanced assurance, this is where you will find those templates that we talked about. So I thought I'd just summarise, we're always looking for case studies. Please do check the open source data, because that really helps us. We've talked about a couple of other things here, guidance and advice that might be helpful. So we have a DIY guide that was produced by a social entrepreneur who got on with raising his own investment, which is available. We have a simple guide to the tax reliefs. We often get asked questions about what the difference between EIS, SEIS, SITR is, and which is the best one that they should use. So we've done a very simple analysis comparing and contrasting them. We also have a simple guide to financial promotions for anybody that is thinking about raising investment and doing it themselves rather than via a platform, or perhaps using community shares. We also have a webinar coming up on the 24th of March, which is designed more for organisations who might be looking at this. So if you want to find a way perhaps for organisations who are thinking about using SITR and want to distill this information to them, you can find out more information on Get SITR about that webinar which is taking place on the 24th of March. And at the moment, we still have plans to offer our Get SITR surgeries, which is essentially some one-to-one time virtually with Neil and myself, essentially where individual organisations can ask questions of Neil. And lots of things actually that Neil has talked about today have come as a result of those surgeries. And then what we're able to do is either to go away and perhaps sometimes test some of those assumptions with HMRC, and then provide more guidance back afterwards. So you can look out for those on Get SITR as well. Is there a link to that webinar? I'll make sure that you get that. You can find it on Get SITR, but I'll make sure in the notes that I've typed up that I will just check that I've got the questions correct and the answers correct with Neil. I'll send those to Morgan later on. As soon as Neil is able to get back to me, sort of depends on Neil's timescales, and I'll make sure that you've got the link to that webinar as well. I think that's probably everything from me. I'm just going to open up to any questions. There was just one thing that I was perhaps thought it might be just worth covering, Neil. I don't think it came up at any time, which is just this a slight change of the reason that potentially SITR is becoming more attractive for community shares issues rather than EIS, and that's around the risk to capital clause that has come up. So I don't know whether it's worth just covering that, Neil.
Yeah, okay, thanks, Mel. Yeah, the point Mel makes is that some community share issues will be eligible for tax relief either under EIS, the Enterprise Investment Scheme, or SITR. So then you get asked the question, well, you know, which one should we pick? And there is one advantage of SITR for community shares over EIS, which relates to the so-called risk to capital requirement. Now, this was a change that was brought into the world of EIS, CDIS and venture capital trusts in the last year or two. And it is a requirement that investors' money, there must be a genuine risk that the investors could lose their money. Now, you'd have thought that was pretty self-evident with any investment in an unquoted smaller business. But it was brought in specifically in an attempt, as far as Treasury goes, to refocus the tax relief on really high risk stuff. So that sounded, when it first came in, easy enough to apply. But then what we saw was in practice, the revenue were taking stances that if, for instance, the social enterprise had any kind of asset backing, their view was that it was therefore not so risky. So we've seen community pubs, for instance, trying to do community share issues to raise funding under EIS, and being told that they would not be eligible because they had assets. And so if they went bust, there would be an asset there that were available to creditors, and therefore it wasn't risky enough. Now, the risk to capital condition is not in the SITR legislation. So if you were a community pub, to take that example, and you were doing a community share issue, you would not have to prove that the money was at risk in the same way as you would under EIS. So chances are you would get SITR where you wouldn't get EIS. So that is one example where SITR has a competitive advantage. The other competitive advantage for the tax relief is not on share issues, but it's the fact that it's the only tax relief where entities can actually raise debt. And the investor can claim tax relief on the debt. So it is perfectly feasible that a social enterprise looking to do a community share issue could also raise some debt finance under SITR and maybe raise issue shares either under SITR or EIS.
Thanks, Neil. Yeah, thank you, Neil. In fact, recently we've come across quite a few organisations that perhaps started with community shares on SITR, but have then gone to top up or to add SITR debt loans to do further development. So it's quite interesting that certainly some of the case studies we've come across is people using both types of SITR investment in order to be able to get to their package of funding together. So I'm conscious that we've got just sort of 10 minutes left, and I know we've answered questions from everybody to come along. As I said, I've taken those notes, but it's just really to open up the floor and see if there are any questions for Neil or myself before we hand back over to Morgan.
I've got a question, Mel.
Yeah.
We talked at one point about a potential step-by-step guide for the investors claiming SITR. So it's something we get asked a lot by our groups. I mean, obviously it's the responsibility of the investor, but they tend to get a lot of queries about how the investors who've maybe never invested in anything before are going to claim. Is that something that's been developed?
Yeah, lovely. Thank you for asking that and reminding me I'd written it down. I missed it off my list. So yeah, we are working on 2 resources currently. Neil's going to do the technical stuff, and Luna that works with me is going to make it look lovely. But essentially, we're going to be producing a 2-part guide that is specifically for community benefit societies. And it came out, because I think as with most things we get SITR, it comes out from talking to the users like yourselves. So it was a great conversation prompted by you and tested with a number of other people. So it'll be a 2-part guide. Part 1 will be for the Community Benefit Society itself, and it will just run through the process of what the Community Benefit Society needs to do and when, in order to make sure that its investors are able to claim the tax relief. And what we'll probably do is have gaps for people to write in the significant dates for themselves, but it can certainly say how long from those dates do these things need to be done. And then we're also going to produce part 2, which is going to be for the community benefit societies to distribute to their individual investors, which will talk the investor through what are the processes by which you can claim the tax relief, so through self-assessment or potentially through PAYE. What bit of paper do you need from the CBS, and where do you need to go? So essentially it will be a signposting. It's not an individual tax advice document, but it will be a signposting. One of the things that we've heard from lots of CBSs is that it can be very complicated and also time consuming when they get lots of individual inquiries. We'll make those accessible and downloadable, and also emailable, so that you can have them to be distributed. And the plan is to have those ready before the end of March. So yeah, watch this space coming soon. I would say that we'll make sure that you get them anyway. But with all of these new resources, we have a mailing list for Get SITR. So if you are keen to be kept in touch with any new resources we put out there, or any new events, new webinars, do sign up and we'll make sure that you get them. That's probably the best way.
Real, thanks, Mel. That's
helpful. If I could just come in on that briefly, since I'm about to write them. If you, Morgan, or anybody else on the call, if there are questions that you keep getting asked, or any kind of horror stories, then please just drop me an email and tell me what they are, because it's really helpful to have as much kind of background information as the problems people are actually facing in practice when we put together this note. So any kind of, if there's a theme to any questions are being asked, if you've got questions you want to ask yourself that you would want included in the note, if you could just ping me and Mel an email, write it down, and we'll try and make sure it's covered in the note.
Absolutely, no worries, Neil. We'll have a chat about that here.
Thank you.
So I haven't got anything else. It's a question really if anybody else on the call has anything they want to ask. No? I think maybe we've exhausted everybody in SITR, and I'm sure it's time for a coffee, water, toilet break, or whatever it happens to be. I'll make sure that you've got our contact details. You can always get us via Morgan or via Get SITR. I hope it's been useful background against everything else. I mean, more and more, I think in days to come, that the point of communities having access to finance to be able to run their own community organisations is definitely not going to be something that goes away. And we will be working and lobbying as hard as possible, not only to make sure that SITR is expanded, but also maintained. And anything we can do to make that easier for social enterprises and charities is definitely in our scope or remit. Thank you very much for allowing us to come into your homes via this Zoom conference. It's still been good fun. I think I'm just about there now. We're sharing all these different bits of technology. It takes a little while. We've got a lot of tabs open. But yeah, thank you very much. And we're going to sign off if there's anything else we need from us.